Hello and welcome to our series. Do you really think you are financially secure? Often we convince ourselves that we are financially secure. Most people, especially high earners, have some nest egg built up and that gives them confidence. But this may not be enough to truly take care of life's needs. In this episode, we will unpack specific needs and how to address them. I am RJ Vasudha Deshpande, a financial services professional, and with me today I have three experts in this field. In this episode, we are going to discuss one of the foundational topic, financial protection. So, let's start by introductions. Shishir, let's start with you.
Hi, this is Shishir Reg. I'm a financial strategist with Anant Wealth Solutions. I specialize in tax diversified retirement planning and financial protection for families and small businesses. I'm physically located in a tri state area of Cincinnati, so Cincinnati, Northern Kentucky area, but I work across the United States. Thank you.
Over to Bhavin.
Hi, I'm Bhavin Shah. I'm a financial professional and I help families by educating them on financial stability in any market condition. Tax free retirement income, guaranteed lifetime income, and with their estate planning needs too. I'm located in our beautiful Northeast, but have clients and teams spanning all the way to Florida and California.
Over to Shams.
Hello, my name is Shams Pirbai. I've been in the financial industry for about 2 decades now, my focus being auto insurance and life insurance. I'm based in the great state of Texas, living with my wife and 2 kids in San Antonio. I love educating clients and families on how they can protect their today and tomorrow.
Thanks for your introductions. So, to start with, Shishir, why
Mhm.
don't you explain what financial protection is to our listeners?
Oh, absolutely. Would love to. So, the financial protection comes under a defensive planning strategy. So, there are four things that come under financial protection umbrella, if you say. The first one is protect what you own, that is your assets. The second one, I would say, is protect what you earn. The third one would be protecting what you owe. And the fourth one is protecting those that you love. So that's what I would say a financial protection means. Thanks,
That is
Vasudha.
a very simplistic answer. Thanks, Shishir.
You're
We will
welcome.
go over some strategies in the coming series. For now, let's elaborate on these four financial protection areas. So, Shishir, can you tell us more about protect what you own?
Absolutely. Thanks for asking that question. Let's first describe what people own. Yeah. So, for example, people consider their assets, right? They may include house, car, boats, rental properties, vacation homes, jewelry, businesses, and so on. So, anytime we buy these assets, the first thing we do is buy insurance on them. Okay. Now, most people think that they are buying insurance, that means they are protecting those assets. But my question to them is, do you really protecting these assets? For example, when you buy a car and we buy insurance on the car, does that mean the car will never get into an accident because we bought a protection on the car? No, absolutely not. The premium we are paying is protecting the monetary value of the car. So, if, for example, if that car gets into an accident, you don't have to empty out your banks to pay for the new car. Okay. It's protecting. So, the protection you bought is protecting your hard earned money, your assets. Same goes for all of our assets, right? We do something similar in by buying the health insurance as well, so that when we fall sick, we don't have to pay up a lot of money from our savings. So, Vasudha, what would be the most important asset in our family?
That's our life, right?
Absolutely, yes, that is us, right? Unfortunately, According to a study done by Insurance Barometer study done by Life Happens and Limra, almost 50% of Americans are missing life insurance as the key part of their financial plan, according to this study in 2022. Okay, so back to you, Vasudha.
That is remarkably interesting, Shishir. Let us come back to that shortly. So, Bhavin, how would you describe the second point? Protect what you earn.
Thanks for the question, Vasudha. Right. So all of us have some form of income, right? Either in the form of a salary, which basically gives us a paycheck because we're employed, or we might be a business owner, small business owner, and we might be getting a business income. Now, employers, they provide their employees with some kind of life protection as part of the benefit package. Typically, we find it in the range of 1 to 2 times of their salary. And in today's time, for a family of four, right, even with two incomes, if one of the earner passes away, that's a big financial shock for the family. Right? I'm not even talking about the emotional side. And no one can tell how long it would take the family to recover from that emotional trauma. But it takes a really long time for most people, right? It's more than what most people plan for to overcome the economic shock that they get, right, when somebody passes away and they have to get back to normalcy on a single income now, right? And that's further reduced. For business owners, the situation could be worse, actually, because if they have not covered themselves with sufficient insurance, their family may not even know how to handle the business, and which might be their only source of income, right? And that everything is placed in serious jeopardy at that time. So when we talk about protecting what you earn, we usually recommend to our clients that at least 10 times their annual income, right? 10 times their annual income as protection for the life. Of course, each scenario is different, right? I'm just using this at least because there is more to it. We will be covering more of that in our episode today later on. So back to you, Vasudha.
Thanks, Bhavin. That was a great explanation. Shams, moving discussion to you. How would you describe protecting what you owe?
Sure, I would love to describe that. For the clarity of our audience, we are talking about protecting what we owe, our debts. One might think, why would you want to protect your debts? Let us talk about a couple of scenarios. So, when someone passes away, do you think the mortgage company or any lender that you borrowed money from, say for example, for a car loan, business loan, or for that matter, any loan, would be sympathetic to your spouse and write off the debts?
No.
There's so many cases out there where people were evicted for not paying mortgage payments or car taken away for not paying their car loan. Just now, Bhavin was talking about employer benefits, where an employer might pay 1 or 2 times the income. I really want you all to think if that money is enough even to cover your total mortgage. And let us say somehow it is. What about all your other daily and required expenses for the family without you? Every day we see new requests via GoFundMe. Not all these cases could be avoided, but many could have been avoided with proper planning and proper financial protection. Back to you, Vasudha.
Thanks, Shams. Now, you mentioned an important term there about proper financial protection. I want to touch on that, but first, I want to ask Bhavin to elaborate on what is meant by protecting our loved ones.
Yeah. Thank you again, Vasudha. I would love to answer that. Right. Protecting your loved ones is very dear to my heart. We all have dreams, but we also have huge responsibilities, right, towards our family and anyone else we would consider family. In my case, for example, I have a wife, right, my daughter, my mother. So my wife and I dream about retiring, like living a very peaceful retirement life, right, somewhere, right, in some corner of the country, traveling the world, enjoying life to its fullest. Right, that's our dream. Now we're also planning to fully fund our daughter's college education, so that when she comes out of college, she's not shackled down by student loans and debts. Now, what if life happens and I do not reach home tonight? Right? That is, I die. In what condition am I leaving my loved ones behind? Should my wife not have the retirement she dreamed of? Should my daughter compromise now on her education, right? Because we were not able to fund it, right? What about my mother? She's old. She'll definitely need to be taken care of, right? So, this is what we mean that when we talk about protecting our loved ones, protecting them, protecting the dreams, hope that shed some life, excuse me, on some light on, that topic.
Yeah. Thank you, Bhavin. This does make sense. We just heard about all these four areas of protection. Now, how do we want to put this all together? In other words, what is the proper protection that one should have? Let me start with you, Shishir. Can you please elaborate on this topic?
Sure, sure. Thanks. I would love to do that. So, one of the things I always tell my clients is that these defensive strategies are bedrock or foundation of your financial house. And when you're making these decisions, we need to understand the emotional aspect, but attempt to keep the emotions out of this decision making, right? And I'll elaborate on that one. So, emotionally thinking, our lives are invaluable. But financially speaking, every human being could have an economic value. Okay. I'm going to give the most generic formula here, right? But depending on everyone's situation, there could be other factors at play, especially considering health and things of that nature, and that could change these numbers drastically. But here's the formula. If people want to note it down, please take out your notepads and write this down. So the formula includes your debts, your income replacement, your mortgage, and your educational needs for your kids, right? If you put all of them together, and we spell it as dime, or debts, income replacement, mortgage, and education, dime. So that's how we can take a value for a human life. Okay, that's how we calculate the life. And this is what we call the proper protection. So now I'll turn to Shams so he can elaborate with a hypothetical example.
Thank you.
Shams,
Thank you, Shishir.
you're welcome.
So let us take a family of four as an example, okay? A husband, a wife, and two kids, ages 10 and 7, as our example. Let's say both parents are working. Husband makes about 100,000 a year, and wife makes about 100,000 a year. The husband has an education loan and a credit card debt totaling about 45,000. The wife has a car loan and her education loan totaling about 30,000. Their house mortgage is 300,000. So let's calculate debt, mortgage, and education needs first, as this would be the same for the wife or the husband. D again stands for debts. So total debts, his is about 45,000, hers is about 30,000. So if you add that up, that's about 75,000. Outstanding mortgage is about 300,000. Assuming each kid's college education is about 50,000 a year, so 4 years that would make it about 200,000. So total for both kids, if you add that up, it's about 400,000. For income replacement, if the family loses the mother, the survivors would need more or less about $1 million. Whereas if the family loses the father, the survivors would also need about $1 million. We're rounding up some of the numbers for simplicity. So putting it all together, the total protection needs for the wife would be about 2 million, and the same for the husband, about 2 million.
That sounds straightforward, but a couple of questions for our listeners' clarity. Why was there a total debt added to both husband and wife's calculation? And why should they get this protection? Shams?
Sure. Let us assume that the wife decides to stop work for some reason. Who do you think will pay down her debt? Or if the husband stops working or loses his job, all the responsibilities shift to the wife, right?
Yes.
So, similarly, if either one of them dies, the debts would still need to be paid. And hence, it's recommended to add total debt when calculating wife and husband's coverage needs. Now, your second question, When should they get this protection? Simple answer: now. There are many reasons, but the most critical one is no one can predict life. Let me ask you this, Vasudha. Can anyone guarantee what moment they are going to die?
Obviously, no. No one can predict that.
Exactly. Since the answer to that is no, the best time to get the protection is now, when we know we are alive. There's also the advantage that usually folks tend to be healthier when they are younger, but even if that's not the case, most insurance companies would surely help you get better ratings on existing policies. If your health improves in future, but if you are like most folks, if you get it now, you are locked in the current health rating for the entire duration of the protection. So get it now. Every year you wait, the rates change and health ratings may change.
Thanks, Shams, for your for explaining that. Bhavin, turning to you, a lot of times I get clients saying my spouse is not working, say a stay-at-home mother or a father. So why do we need to get life insurance protection for a non-earning spouse?
That's a really good question, Vasudha. People should always consider why they need protection and how would it help survivors if life happens. So earlier in the episode, right, we described there are four areas of protection. Right? If one of the spouse is a stay-at-home parent, they're taking care of the home front and other dependents at home. If tomorrow they are not in the picture, right, that's the question. Who would manage all those things? The spouse who was earning would now need to figure out the home front and the work front. Right? Example: the kids maybe need to be sent to daycare, or they need to hire a nanny. Right? May need to pay someone to cook and clean because they need to go to work. Somebody has to still feed the kids, right? And the spouse which is remaining. There's so many things like that which might otherwise take for granted, but will start costing real money because one person has been taken out of the equation, the person who was at home. So with my clients, we typically discuss considering stay-at-home parent at the same income as a working spouse when they have kids. Back to you.
Yeah, thanks for clarifying this. My next question is for Shishir. So, we discussed financial protection and determined the need by using dime formula for each individual. Now, how should one go about getting this proper protection and what different types of life insurance policies are out there?
Oh, that's a good question, Vasudha. So I want to emphasize that so far we have just discussed what proper financial protection needs are, right? The amount, the dollar value. But what the proper protection is depends on each individual and their situations. So let me answer the second question first. That is, how many different types of policies are out there, right?
Yeah.
So there are numerous types of insurance policies out there. To name a few, we have term life, whole life, universal life, annually renewable term, variable insurance, or variable universal, credit life, final expenses, and so on and so on. Right? We most commonly hear about the term life, okay, which is by definition is only temporary for the term you select. So it's 5 years, 10 years, 15, 20, 30, and so on. Okay, not every type of policy and even every insurance company's policy are suitable for everyone. Okay, that is the first thing people should understand. We often hear about people feeling like they were sold a wrong policy, and that leaves a bad taste in their mouth about protection overall. Okay, I will tell you that there is no such thing as a bad policy. It is very well possible that the policy you were sold may not have been the right policy or right fit for you, or it may have been a good fit at that point in time. And there are several reasons this happens. One of the most common reason is that whoever you worked with just sells one type of policy or just sells one insurance company policies. So they are looking at best match in their universe, which may not be the best fit for you, right? Now, we all here are independent. What that means is we represent many companies. So we can find the best match from multiple carriers. And moreover, we all follow a strict method that is based on education first before providing any recommendations. Okay. For this to happen, there must be more open dialogue between the client and financial representative. We all here abide by high ethical standards and we maintain confidentiality for the information that is provided to us. Now, every day we come across people that do not want to disclose their financial picture and want to just buy a certain product. So I want to urge this audience to work with financial professionals that are, first of all, independent, and secondly, that you think you can trust. Okay. The ones that can educate you well on different policy types, different riders, different provisions in the policy. Okay. And most importantly, time. As Shams mentioned earlier, time is the most important factor in financial protection decisions. Okay. Sorry for the long-winded answer, Vasudha. Back to you.
That's all right. We are all here to learn, and the points you brought up are really important. Now, we are running up on our time together, but I want to ask these two more questions before we end. Shams, hoping you could answer this. When is a good time to look into financial protection products? When we are in 20s, 30s, 40s?
Sorry, the right time to get the financial protection is now, not tomorrow. Okay? Life can happen any day, my friends. The right time is really today. You may think, oh, let me get in shape, and next year or 6 months down, I will look into this. It will be good. If you could get in better shape, because you can always go back to the insurance provider to request better health rating than what you get today. And they will honor it. They will never push you down on the health rating what you got now. So remember that. Now, on the other hand, for any reason, either you are diagnosed with some serious condition between now and the future date when you want to get your protection, at that time, the insurance company may respectfully decline your application altogether. So, the earlier you start, the more cost effective protection you can get, especially on the permanent type of policies, as you can build a good nest egg through these policies.
Thanks, Shams. Bhavin, last question. This is about the cost. If someone is interested to look into financially protecting themselves and reach out to any of you, what should they be expecting to pay for for your services?
Yeah, great question, Vasudha. Right. So there are typically three types of financial services professionals out there. There's one which are called as fiduciary, right? That means these advisors have a fiduciary duty towards their client, which is you. So they will prepare plans for a fee. They charge you for that. But they have nothing to do with providing products or services. They've just prepared a plan. The second type are captive, right? Or the exclusive financial services professionals. These people work for a particular company, either insurance company or banks or more brokerage houses. So while they may not charge any upfront fees, they may have fees based on the assets you invest with them. That would be 1 to 3% of your assets on an annual basis sometimes. And the third type are the independent financial services professional. This is a place where all of us are. Right? We do not charge any fees for our services. The way we make money is that if you like the recommendations we made after analyzing your individual financial situation and you get the products or services through us, the product provider, because we're independent, we can go to any product provider. That product provider pays us. So as Shishir explained, we work with many carriers, but we get the best and the most suitable fit for the solution for you from this larger universe. So in a nutshell, we do not charge any consultation fees for our services. It's free to all our clients.
Great. Thank you so much, Bhavin, on elaborating on different types of financial services out there. All of you, thank you so much for this great conversation. Our audience out there, If you like what you learned today, you will have more exciting sessions coming up. So stay tuned. If you have more questions, comments, suggestions, please reach out to us. I'll be sharing the details after this. Our information is right here on the screen. Please reach out to any one of us to see how we can help you to be properly protected financially. In our next segment, we will be discussing estate planning, that is, will and trust, and the importance of this along with healthcare planning documents. In subsequent episodes, we will cover different types of life insurance, policies, and applications. So stay tuned. Thanks. Over and out.